Investor Shed Podcast with Nick Beveridge and Jeremy Kitchen. They're on the path to financial freedom and they're taking their community with them. Stay tuned for the best free real estate investing advice on the internet.
Welcome back to the Investor Shed Podcast. Nick Beveridge here with my squeaky co-host, Jeremy Kitchen.
That's what my new daughter sounds like. She just squeaks like a motherfucker. Speaking of squeaking like a motherfucker, we got a squeaky clean episode for you today, don't we,
Yes,
Nick?
we do. Squeaky clean.
Yeah, it is part 2, and we go into this the other intro of the creative financing. So stick around. You're not going to want to miss it. We talk a lot about Sub 2, and we barely shit on it, which is pretty cool.
Barely shit.
Barely shit. Talk a lot about hard money loans and other useful strategies for getting into real estate investing for little or no money down.
We also deep dive into gift funds.
Oh, yeah.
And land contracts, otherwise known as contract for deed.
Oh, my land to
Jeremy
land
didn't know
contracts.
about it before we started talking about
I
it.
had no idea. I learned something new every day on this podcast, which is great. But the one thing I'm really looking forward to learning about this episode, Nick, is what kind of
food should we be eating while listening to this podcast?
Yeah.
Now, do you want me to answer, or did you have?
Oh,
something in
I want
mind?
you to answer. I'm curious to know what the Nick Beveridge wants for food for indulging in this.
I want you to go to Costco, if you don't mind, and get a couple of those $4.99 rotisserie chickens that are so underpriced.
Wow.
And I want you to tear off all the drum legs and start playing the drums on your steering wheel with the drum legs while eating them and listening to this podcast with your window down and just shouting to the world, the Investor Shed Podcast rocks.
Did you know?
Eating the chicken legs.
Did you know? Fun fact: I learned this actually the other day that it is actually encouraged to listen to the Investor Shed podcast while you're driving, and it's also encouraged to have drumsticks while you're driving. Cops cannot pull you over. Actually, if you have Investor Shed going, you're basically
You just have them listen to this clip.
Yeah, you just say Jeremy and Nick said you could. You get immunity from any sort of driving consequences if you're listening to the Investor Shed podcast. So
That's
take off your pants, roll some drumsticks, and let's freaking go.
Let's go. You're going to love this episode. I guarantee it.
I don't.
Welcome back to the Investor Shed Podcast. Nick Beveridge here with the father of the hour, Jeremy Kitchen.
If I only get that one time in my life for 1 hour, this would be the time. I am the father of the hour. Yep, had my baby this last week, so family's doing good. But
Congratulations.
Thank you very much. But we got important stuff to talk about today, Dick.
More important than your new daughter.
Yeah, very much. It's so important. What we got today is basically we have the Empire Strikes Back of our creative finance episode. This is the sequel, number 2, ladies and gentlemen. Creative finance, part 2. We're going to do a deeper dive into what we talked about and bring up some more strategies for those trying to get into investing. So
Yes, that is what we are trying to accomplish here.
Mm-hmm.
So if you remember last week, or not, it wasn't last week, it was a couple of weeks ago.
Yep.
What we talked about was doing cash out refis to create or to acquire properties, using HELOCs to acquire properties, using personal loans. Talked about seller financing a little bit. We touched on assuming mortgage, different from seller subject to, and I don't think we talked about subject to, so we'll talk about that today.
yeah, absolutely.
There's also lease purchase, and we did the BRRRR briefly. We talked about the BRRRR. I think everybody knows about the BRRRR, so we'll just touch on that maybe a little bit more today, but
Sure.
we won't make that our whole focus. And then we briefly touched on wholesaling and house hacking.
Yeah, and at the end of the episode, we talked about our directed IRAs and how you can use those to invest in real estate. For part 1, please go back and check out the episode. Brief housekeeping, of course. If you find this information helpful or useful, please A, share it with a friend, and B, go on Spotify, Apple Podcasts, YouTube, leave us comments, and leave us 5-star reviews. We will hunt you down.
We will.
If there's no 5-star reviews. If there's a 4-star review, I like to find people's personal information on the web and do a little bit of what we call harassment.
Not just that. I mean, if you've been paying attention at all, you know that Jeremy's a spouse biter.
I am a spouse biter.
And he will bite your spouse.
Yep. I'll find if you have your crawl space unlocked in your house, I'll find a way and I'll bite your spouse. Lock up your.
You have crawl space vent covers.
Yeah. Yep. Get that crawl space lock insurance. Otherwise, I'm coming for you. But let's get into it, Nick.
All right. Let's chat about gift funds.
I like that.
This is going to be a weird one to get into immediately, but I think it's a great way for the people out there that want to maybe get an FHA loan or a conventional loan,
Yeah.
but still don't have the down payment. Now, with an FHA loan, that is a government-sponsored loan where FHA will guarantee the almost the 20% down payment that's mostly needed with conventional loans. So to give you a little background, what that means is almost any lender, when you're getting a loan on a house, will approve the loan if they're in an 80, and what that means is loan to value. So if the value of a property is $100,000 and a borrower can get a loan for $80,000 and a bank says, yeah, I'll do, if you only need $80,000, we'll do that loan.
Sure.
Usually it's in the form of them bringing a down payment of $20,000. But if a property's worth $100,000, a bank typically doesn't want to have a loan out there that's more than $80,000, preferably less.
Right.
But that's why you have so much of this idea of, almost every loan you need 20% down.
Right.
That's because if a bank has to take the property back, they don't want to be in a position where they're going to lose money.
Yep. Yep, and to just kind of expand on that a little bit, Nick, obviously, and that's where, your if you're going FHA, that's where your mortgage insurance comes in. So the mortgage insurance actually is called the PMI.
Yeah.
It's going to be an additional payment that's wrapped into your house payment, your mortgage.
Yep.
But basically what that is that's almost insurance, if I'm not mistaken.
FHA insurance.
Yeah, FHA insurance for that extra, because if you're doing FHA, most of the times it's 3.5% down. That extra insurance is basically going to cover that 18 or 17%.
16.5%.
16.5%. Thank you. Yeah. 16.5% difference. So that's basically if you end up having to go foreclosed on, that insurance kicks in.
Yeah. So basically, if you have to get foreclosed on, it's HUD's problem now. If the bank, and I don't know the exact how it works on every loan, every bank's a little bit different, but for the most part, if you've ever heard of a HUD home, that usually means that somebody got an FHA loan on that property and then they didn't make payments, and then the government had to take the responsibility for taking that property back.
Yeah. Bank basically says, not my fucking problem.
Yeah, give me. I got my loan to value secure. I'm going to get paid off. Bank is the one that is usually in a secured position with the LTV always.
Yeah, but going about what we were going to talk about with this too. So gift funds, right? So a creative way to get into this. If you don't have the 3.5% down, you can utilize what's called gift funds, and gift funds can come from a variety of sources. They can come from your parents, they can come from your employer, they can come from your spouse, they can come from just people you know, and 100% of your down payment can be covered with gift funds, which is very interesting.
Yes, for FHA loans specifically.
For FHA specifically, correct.
That might cover other as well, but it can be donors from, like you said, family members, employers, charitable organizations, government agencies, and what that means is like in Idaho, for instance, this is very common for the Idaho Housing Association to help out with a 3% credit to buyers that qualify or borrowers that qualify. So basically, you're getting a loan for an FHA loan. For let's say it's for just simple numbers. I know you're not going to buy a house here for $100,000, but
I wish.
you're buying a house for $100,000. You get an FHA loan for $96,500. $96,500. That's an FHA loan, and then the Idaho could even pitch in another 3%. So you have to come up with $500.
Yeah. Pretty cool.
0.5%.
And what's cool is and a great way to utilize this strategy, I think, like if you were really like focusing on like, I just can't get the funds, I can't get the approval, whatever it is. Say you have a family, a rather big family, and you have a birthday. People typically get you just like, maybe a Fred Meyer gift card or a Red Robin gift card or anything. You can have people just give you cash, and you can use that cash as long as it has a proof of funds. Is that correct? Like a receipt of funds, a donor of funds?
Maybe.
Okay.
I'm not an underwriter. We'll have to get a lender on there to talk about that.
Sure.
But in general, you should just be aware that gift funds are a thing. And we're talking more traditional loans here.
Sure.
To be able to creatively buy something with little to no money.
But there's just ways to do it, right? So
Yeah.
if you find yourself not being able to, like, utilize the gift fund method,
Yeah.
set up a GoFundMe.
So a more realistic example, like here in North Idaho, an entry-level house about $400,000. So if you were to get an FHA loan combined with Idaho housing, you would need $2,000 down.
Not bad.
Not bad for a $400,000 house. Now, are you highly leveraged? For sure.
Yes.
But if you find the perfect house in North Idaho for 400 grand that, let's say, has multiple bedrooms in the house, and you can get roommates, or it has a basement that you can turn into an ADU and you can rent out half the basement.
Yeah.
This is what we're recommending you get in on if you're here and you just don't know how to get started because things are so damn expensive.
Sure.
You may think to yourself, man, I don't have 60 grand down and can afford $3,000 a month
Yeah.
for a simple house. I'm just going to rent for $2,000 a month. This is how it's done.
Yep. And a good friend of ours, Craig Curelop, he wrote the house hacking strategy. That's basically the strategy he's talking about. In his book, he talks a lot about there's a sliding scale of comfort and profitability, right? Are you comfortable having a lot of roommates? Probably not. Let's be honest, right? But are you comfortable getting your mortgage paid and getting your mortgage paid down and building equity so you can do that again? Like, you have to decide what's best for you at that point. Do you want to, make more money, or do you want to live more comfortable? And Nick and I always talk about it too, like, just house hacking is it's the easiest way to get started in this.
Yeah, it's the easiest, and it just makes sense on paper.
Yeah.
Especially if you are willing to sacrifice a little bit of privacy.
Yep.
Because what's the alternative? If you're not owning a house, you're renting, and at any time you can get kicked the fuck out.
You can.
Assuming that you're on a month-to-month lease.
Right.
Yeah. So that's something I always warn people of, because a lot of tenants kind of don't feel that way unless it's happened to them before. But me being a real estate agent for 14 years now,
Yeah.
I've seen it happen multiple times where people think that they're secure in a rental, they're paying low rent, and then eventually something happens with the landlord. Either they need to sell the property, they're getting a divorce, or they just need to cash out because they're like, man, this thing's worth a lot more than what I'm bringing in. I don't want to raise the rent $1,000. Let's just sell this thing.
Yeah.
And then you have to figure something out in 30 days. And then you're kicked out on the streets where you have to pay market rent. It happens. Like, you may think it will never happen to you if you're a renter, but it happens all the time.
Yeah. I see it all the time just on Facebook. Like, people getting kicked out of their rentals, and it's a stressful place to be in, right? And if you can buy a property, please do it.
Yeah, and I don't say this to be mean, but like, that's just life, and that's just the way it is. So you got to just deal with it. Don't complain, because complaining is not going to solve anything.
It's true.
You got to figure out how to figure it out in life.
You got to figure out how to figure it out. I love that.
It's called being an adult. It's time to figure it out, and we're trying to help you figure it out.
For sure.
All right. Next, we touched on seller financing quite a bit on the first episode, so check out part 1 if you want to hear more in-depth examples on how we did that. Something, an alternative to seller financing, if you want the seller to feel a little bit more secure in doing this thing, is called a land contract, or also known as contract for deed. Do you have an idea how that works?
Nick, I'm going to be honest with you. I have no idea what you just said. Please enlighten me too, because I've never done a line contract. Like, I've heard the term, but I don't know exactly what it entails. So enlighten me.
That's good to know.
Yeah.
Okay, so for those out there listening, I haven't heard of that. This guy's in real estate, hasn't really heard of it.
Yep.
So it's something that's little not as known, but it is a very effective strategy to buy properties directly from sellers that are okay maybe doing something like seller financing, but they just feel squeamish about having to maybe foreclose on you.
Sure.
Having the title in somebody else's name. This solves that problem. So with a land contract or contract for deed, it's the same thing. Just hear that name again, contract for deed. So basically it's almost like buying a vehicle and getting a loan. When you buy a vehicle and you get a loan, do you have the title, or does your bank?
The bank.
The bank has the title. Now, when you're buying real estate in general, do you have the title, the ownership, even if you have a loan?
Yes.
Yeah, you do. There's a difference there. But people that get loans on cars, they have the ability to drive it as much as they want. They can paint it, they can wreck it, they can sell it.
Yeah.
They can do whatever they want with that thing. And once it's paid off, then they get the title,
Right.
official ownership. But they have the right to do whatever they want with it because they're in a contract for a title.
Sure. Okay.
So this works basically the same way. It's just an easy way to give it an analogy.
Gotcha. So if I'm understanding correctly, instead of like, you taking title and ownership right when you buy a house, the original owner would hold title in their name until you paid off the note, I'm assuming, correct?
Yeah.
Okay.
So it's just like seller financing. The biggest difference is the deed, official ownership, does not go into your name until it's paid off.
Gotcha. And so seller financing, obviously, the deed goes into your name when the contract is complete, correct? Or when you sign the paperwork, right?
Yep. When you close escrow. When you close escrow prior to paying off the note.
Cool. So what are some of the benefits of doing a land contract like this then?
So it makes the seller feel a little bit more comfortable in the fact that if they had to take the property back from you not making payments, it's easier.
Gotcha. Okay.
You don't have to go through a foreclosure process.
Gotcha. So it's just more of a peace of mind for the seller at that point, and an additional option to have in your arsenal for, acquiring properties. I think that's really cool.
Yeah. Other than that, you get pretty much all the same benefits.
Okay.
As an owner, if you acquire properties this way.
Do you get the depreciation?
Let's find out.
Okay.
That's a good question.
Yeah. Because
while I research this, you want to chat about our next topic?
Yeah. What are we talking about next?
It's not on that list. It's right here. Let's talk about joint ventures.
Okay.
And partnerships.
I can do that. Yeah. So while Nick's researching, if you can get depreciation on a land contract or land deed, the next topic is obviously joint ventures and partnerships. And if you've listened to the show or you have any experience in real estate, like this is such a great tool to get started. Most of the properties I've worked on have either been joint ventures or partnerships. So that's what I can almost speak to the most. Cool thing about it is, you get to leverage what other people have and utilize other people's resources, and you get to come together for one big goal to hopefully acquire properties and acquire more properties together. So couple ways we've done that. I know Nick has done multiples of those, and as soon as he's done researching, he'll speak on these too. But I've done joint ventures where I put in money. I've done joint ventures where I put in, quote, bodily services into my contracts. Yeah, we've done it in a lot of different ways to, whether I'm helping out with the demo and reno, I'm helping out with the down payment, I'm helping out with the hard money loan. It's just nice to be able to utilize everything in your pocket, right? And acquire these properties. So anything you want to say on that, Nick?
Yeah, I mean, I do it so often, so we're going to go pretty deep into joint ventures and stuff, but thank you for giving it a nice intro.
Sure.
Okay, so the general rule when it comes to this, going back to land contracts, contract for deed, when it comes to getting the depreciation, let's see. In many cases, the buyer under a contract for deed is considered to be the equitable owner of the property. And this means that having the benefits and the burdens of ownership, even though the legal hasn't passed yet. So the buyer is treated as an equitable owner.
Okay.
And they may be able to claim the depreciation and other tax benefits like mortgage interest and property tax deductions.
Interesting. Okay. And the other question I was going to ask with that too, like, so obviously if the original owner of the land contract is keeping the title,
Yep.
Are you able to refinance while you're in that loan?
That is a good question. And it depends on what's in that contract.
Okay.
So if you have the ability to pay off early, I would imagine so.
Sure. Okay.
So it depends on what you put in that contract and going on that depreciation too. Now that's something to keep in mind. If the contract stipulates that the seller is going to retain the benefits and the burdens of ownership to be able to get...
You're good.
Oh, I got a frog in my throat. To be able to get the tax depreciation, then it would become the seller's benefits.
Okay.
So it has to specifically stipulate in the contract if the seller wants to retain those benefits. But by default, the buyer of a contract for deed is assumed the equitable owner.
Gotcha. Okay. And that's just, a different strategy where I was trying to think of like, if you say you get a seller finance or a land contract and they don't want to keep it for a 30-year note or anything like that, you can get them under contract. And then if the deal makes sense and you're able to get approved for it, of course, like find a way to refinance that quickly, get them their note paid off. And then you just have a loan in your name and titles in your name at that point, right?
Yeah, you can do that.
Yeah. So you can use that strategy and utilize that strategy and just kind of morph it into other strategies. I'm sure you can do that with a lot of these too. So just take a part of one. You can part BRRRR, you can cash out refinance, and then there's a lot of things you can do with that. So
yeah. So I'm gonna tell you the story of my very first joint venture.
Let's go.
And the reason why I structured it. Well, when my brother and I first got started flipping homes in 2014, we did our first 2 or 3 by ourselves, and we took title in SN Homes Construction. Sorry, not SN Homes Construction. SN Homes LLC.
Yep.
That was our flipping company, and I was an owner. Sean was an owner, and I would usually get the best deals right off the MLS. Old bank inventory is like what I was heavily looking at. And I think it was maybe 3 or 4, maybe 4 or 5 deals in actually, where I came across a HUD home that was listed at my Keller Williams brokerage by another agent. And I went back and forth for weeks negotiating online with the HUD home store. And I got this house that was once listed for 90 something thousand. I think it was over 100 at first, and then it was in the 90s. It was in Rathdrum.
Okay.
And what I did was, as a tactic, I would make an offer. I think I made an offer in the around 65, if I remember correctly. And they came back and they rejected it, and it took a couple of days. A couple days later, I would send a new offer. And I would lower my offer, lowered it to like 64.
Okay.
And they would reject it. You had to play the game. A couple days later, submit a new offer because it would take a couple of days to respond.
Sure. Okay.
And at the time, not much action was going on. It wasn't a heated market like it is, today or a couple of years ago, a few years ago. So I would make another, third time, dropped it another 1,000, 63, and rejected.
Okay.
Then a few days later, sent another offer, 62. Countered at 62.5.
I love it.
Yep. The HUD home store countered at 62.5.
Right.
I accepted it. I sent off all the paperwork. We had to mail away.
Gross.
Yeah, it was a process. You're dealing with the government and a brokerage and an asset that's owned by the government. So there's weird things. I think it's more streamlined now.
Sure.
But this was 10 years ago.
Okay.
And so I found out about a week later that I ended up getting rejected because I was an agent at the brokerage that it was listed with.
Oh.
So there was a conflict of interest.
Gotcha. Okay.
So what I was able to do was I was able to take this deal that was still off the market because it was in a pending status. And I was able to get some partners that I met at the REI. And that it kept asking me, hey, if you ever come across a deal, we want to help. We got money.
Sure.
We just want to do our first deal.
Yeah. I love those people.
Yeah. And, they said they have, I don't know, up to 150 grand or so that they can put in that's in a checking account. And I thought, why don't I approach these guys? I'll be a joint venture. I won't be an owner.
Right.
But I'll be a joint venture. And I found a template online and modified it. Afterwards, I brought it to an attorney. He said, yeah, it looks good.
Yeah, that's awesome.
But I did this whole transaction without the attorney's approval.
Whoopsie daisy.
But what I did was I said, hey, let's do a 50-50. You guys fund this whole thing, put it in your name. We're going to do the renovation. You're going to fund the renovation.
Yep.
And we're going to walk you through this whole thing and teach you what we do.
Nice.
And it worked out really well.
That's awesome.
And I think we sold that thing for 140 something thousand. I think we all walked away with like 20 grand each.
After renovation.
I think we
costs,
had a $40,000 profit or something like that.
That's awesome.
But it was, instead of me walking away, I was able to bring on board a joint venture partner. So I had equitable interest in that deal after it was purchased by them. Got them the same deal, 62.5. And in that joint venture agreement, we're able to put whatever we want. So we just agreed on, okay, you're going to fund it all, but this is a partnership. We're intending to fix this place up and resell it for a profit, and we're going to split the profits and or losses.
Okay.
And yada, yada, yada. And it was a couple of pages. And if anybody is going to do a joint venture out there and they just want to see what I've used, I'm not going to recommend to use it. But feel free to email, reach out to me.
Yeah.
I'll share my joint venture with you that I've used. I don't mind doing that.
Yeah. Pretty easy template.
Yeah. And I've modified it over the years.
Sure. Something I would definitely say, obviously seek legal counsel if you're going to be getting into any sort of business with any other individual or entity that you're not familiar with. But if you're comfortable with your people, just a pretty easy joint venture agreement should do the trick for you.
Yeah. So the nice thing about that was we didn't have to create an LLC. We didn't have to become business owners. We didn't have to start up a website.
Right.
There was none of that stuff. It was just a simple agreement, 2 pages long, that outlined how this deal was going to play out and who was going to get what and who was responsible for what and what would happen if people didn't perform.
Yeah, I think that's really awesome. And I want to go back to the beginning of that real quick. So I want to talk about specifically your negotiation tactics on this deal, right? You said it was on the market for how much?
Initially it was 90 something.
97,000.
Yeah,
that's
it
okay.
Was like in the 8. They may have. Yeah, it was. I think it was in the 90s when I was negotiating.
That's perfect, and just what I want to talk about, right? So like you offered 65 at the beginning.
Yeah.
Most people, when they get denied an offer, what do you think they're going to do? Do you think they're going to go up in price or down in price? Typically, if you're denied an offer and you want the property, you're going to start inching your way up, right?
Yeah.
You don't have to do that. You can inch downwards.
Yeah. Well, it tells their algorithm that they're overpriced because
Right.
they keep getting these offers that keep coming in lower than the last ones they got.
Yeah.
It doesn't look good because they have to report these things.
Right. And when they're looking at all the offers coming in, and Nick sends an offer for 65 and they're probably insulted at the beginning, and then
They're not insulted.
it's the government.
Yeah,
They're not insulted.
They don't care.
They don't really care.
They just know what they can do and when.
Right. But like I said, like after a while, like they probably don't want to hold on to this asset. This is something that they just kind of want to get off their plates because it's almost a burden for them. Like, but you stayed vigilant and you were slowly inching your way down. And I love that you like kept getting denied 3 times, and then eventually they countered you $500 more than your second lowest price.
They certainly did.
Yeah.
It was time to get rid of it.
Right.
It was a combination of luck and just wearing down an asset manager.
Yeah. And that
timing.
Take note of that, please, because some of real estate is getting lucky with putting in the right offer at the right time, but you knew your numbers in your head, and you knew okay, this is what I need to buy it at to make any sort of money.
Yeah.
And you just stayed with it. And obviously, this was not an emotional decision. This is what we call logical decision making when you're making real estate investments.
Yeah.
Right. You kept going, and you're like, I want the property, but I'm not going to go higher. Right.
Right.
There's no point. Why would you?
No, you got to buy right.
Yep.
No matter what, always. But this was another. I don't know if you caught it, but I didn't put any money into this deal.
Yes.
And we did a really good job. We built a shop. I got to learn how to build a shop from scratch.
Okay,
and
that's awesome.
going through Ziggy's and getting a shop kit and having other people put it together. I wired it myself. I didn't have to, but I thought it was at the time I was getting into being an unlicensed electrician, and I thought it was just fun.
Yeah.
And we took this house and we really. It was creative the way we fixed the problems. The reason why this house was not selling was because the bathroom was the size of a little closet.
Okay.
And some of the plumbing was sticking out of the wall. And it was just like, how can you remodel this in a way like the bedrooms are just too small and blah, 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 blah. But I saw a totally underutilized side of the house where this second living room was. And I'm like, why don't we turn that into a bedroom? Tear down the wall in between these 2 bedrooms. make that one large bedroom, and then by tearing that down, we can also take a portion of half of this one room.
Yeah.
Because we don't need 2 rooms for one. We can use 1.5 for a good space.
Right.
And then we extended where we had this huge bathroom with the dual vanities, and then we finished the basement.
Yeah.
So we turned it into a very functional move-in ready house with a shop under 150 in North Idaho. At the time, you can imagine it didn't take long to sell.
Sure. And just kind of diving in a little bit deeper on this one, Nick. So you bought this one from the government. How do people, I know these deals don't exist right now, but if they did, how would people go about searching for these?
HUDHomestore.com.
I love it. HUDHomestore.com. Official non-sponsor of the episode, ladies and gentlemen.
Yeah.
And I just want to talk a little bit, like with partnerships and joint ventures too, because that's what we're on. Like, it really comes down to, I think, 4 things when you're trying to do a partnership. You've got your time, you've got your deal flow, you've got your money, and you've got your experience.
Yeah.
And deal flow, what I mean by that is like, you've got your wholesaler or people bringing you deals. Time would be, people wanting to work on the property or analyze the property. Money, because obviously you can bring money to a deal. You can bring money for rehab. There's plenty of different ways. And then experience. That would be someone like a contractor or someone who is good, who is a handyman. Partnering with those type of people is really great because you're just filling in. And what you really want to do is fill in an area that you cannot provide.
Yes.
Yeah.
Yeah.
Or you want to leverage out, basically.
Yeah. And part of what helped make that deal more profitable too was the partners that I brought in. They really wanted to learn how to fix up a property, and I put them to work.
Yeah.
And all that labor was free.
Yep.
And they loved it.
Not only was the labor free, you didn't have to come with any money. So
but we hired out a lot.
Oh, sure.
We still had like Jesse Robinson, our main contractor, and Sean was involved. Sean got part of the profits.
Nice.
Jesse was paid by the hour. But we did the whole thing with one paid contractor.
Okay.
That was being paid $25 or $35 an hour at the time, something like that.
It's pretty good.
Everybody else was, it really depends on the project and how many we have going on. But if it's onesie twosies, I would really prefer to be an owner of the property with my LLC and be a joint venture now for sure. Knowing what I've gone through.
Yeah.
Knowing that there are times where your partners do not perform. And it's a lot easier to deal with them based off the performance in your joint venture versus them an owner of the property via a member of the LLC or something like that.
That makes sense for sure. Good way to put that. Thank you. I just wasn't sure going forward. Like, are you planning on? I mean, I don't know if you're planning on doing any more partnerships, joint ventures, but it's just such a good, solid way to get in, and it's a good, solid way to get a job done without having to over leverage yourself.
Yeah, me personally, because I've been through so much rough lessons lately, I guess you can say, with different partnerships. I for sure am going to not at all rush into getting into any more LLC partnerships with people.
Sure.
And I would still definitely partner with people if it made sense.
Sure.
And I think the joint venture is that agreement is a golden ticket.
I agree.
For people that are skeptical about somebody they haven't worked with yet.
Yep.
Yeah.
And this is kind of going in a little bit too far into the rabbit hole of this, but like Nick said, with contracts and stuff, just make sure when you're making a joint venture, just spell everything out as clear as day. What your roles are, what their roles are, and start going down that rabbit hole with like, okay, if this happens, this is how we're going to handle it. And if this happens from there, this is how we handle it. Like, just be 7 levels deep of understanding. That way, if anybody has any questions, you can just pull out your joint venture and be like, well, right here we signed, and this is what's happening. So we follow protocol.
And if you want to step it up a notch or two when it comes to this, here's what I would recommend. Get a phone app that has a transcriber and sit down and have a discussion while it's recorded. Yeah. And have your entire discussion, speak for 30 minutes to an hour with your potential partner about all the if, when, what we're going to agree on. Do that. Have that full discussion, because you're not going to probably remember and write down everything. Right. But get it all out there as much as you can, and then download that transcript, upload it to ChatGPT, and say, hey, could you please fill out a joint fill out a joint venture agreement based off what we talked about and agreed in this transcript.
Right. And then at that point, everyone can sign from there and make sure there is clear understanding. Because I was going to say, your transcribing app isn't a legal contract, of course.
No. So take that whole transcript, put it into ChatGPT, and say, can you take this this whole conversation and turn it into an agreement, a formal agreement, in a joint venture based off this property, based off what we talked about. Here's what we plan on purchasing it for. Here's the plan on what we're going to sell it for, and then everything else that we talked about. If we're missing anything, let me know, and then you can ask ChatGPT, what key details are we missing that we still need to talk about?
Yeah.
And I just think you're going to save a ton of time and money not having to go to attorneys for things like this. Initially, if you take it up a notch or two with all your due diligence as much as you can.
Right. On basic things like that, it's hard to recommend it, but like the legal side of me says you should still take it to an attorney just to make sure you cross your T's, dot your I's type of thing.
I'm talking about all the prep work for an attorney.
Sure. That's what I'm saying.
I totally agree with you.
Yeah.
What I mean is the initial, if you were to hire an attorney, then sit down and have all this conversation with the attorney, you're racking up the hours.
I get it.
If you were to have a conversation in advance for an hour with your person, you can save $300-400 easy just by having all that already out there, and then upload it to these AI tools. Spit out a joint venture agreement based off what you talked about.
Yeah.
And then sit down with an attorney and say, this is what we've already talked about.
Right.
Here's our JV.
These are the terms we want in there, type of thing.
Terms. What are we missing here? What is or isn't going to work?
Yeah. What do we need to omit?
But that will shave off a lot of time. We're talking 90% of the time.
Yeah, I agree.
And it's all about trying to save you guys money.
Right.
Hey, quick commercial break here. Thank you so much for listening to this podcast. I really do appreciate it. If you want to give back, let me help you buy a house, or I can help you sell a house. It's the only way I make money when I'm not investing in real estate. I don't make money on this podcast or the events I do, but I do make money only when I help people buy and sell houses. So if you're looking for your next investment and you're here in North Idaho, I want to help you personally. If you are not in North Idaho, I can still help you out. I have a vast network of referral partners all across the country in Keller Williams Realty, and I can find the right real estate investor savvy agent for you so you don't have to. Doesn't cost you a thing. Thank you for your support. Back to the show.
I think that's great. That's a great way to put it,
give
Nick.
the best advice we can.
Yeah, best advice we can, for sure. Anything else about joint ventures or partnerships? I personally, this is one of my favorite ways to do business. It's hard to get this ball rolling by yourself most of the time, and it's just so easy to leverage what other people are doing. Specifically you, right? You bring me a lot of deals, and you're like, hey, I need money for these, and I just happen to have some, right?
Yeah.
And I happen to have a decent work ethic where I can help demo and reno the house. All right, this could work.
Yeah, and you just got to be creative with these joint venture agreements, because you can put whatever you want in them. This could be a tactic to, one of your partners in this joint venture. Either maybe they're going to get the loan, and that's what this says. They're going to get the loan.
Yeah.
You're going to help with the down payment, or vice versa. Or you have another partner. Maybe there's three partners. One guy's bringing the money. One guy's doing the work, and one guy put together the deal. And that's really common with a lot of the deals I've done in the past. Usually I'm the deal maker. We got a money guy and we got a construction guy. And then it's a clean, easy 3-way partnership. But the great thing about doing that on a joint venture agreement versus having a whole business, LLC or something like that, in my opinion, just with what I do, it makes sense for me.
Sure.
And I'm not giving blanket advice to everybody.
Right.
But I'm giving advice and just sharing my thoughts.
I agree.
It works best for me to have a joint venture from here on out, instead of I have these companies that I share ownership with other people.
Sure. Yeah, I think that's great. And then, just the joint ventureships. They're just a great way to get started. So.
All right. So we talked about gift funds, land contracts, joint ventures, partnerships. Now let's talk about the juicy stuff, taking on seller's debt.
Juicy.
This is what y'all been waiting for. And we've shit on it before.
Which we will continue to do, probably.
But hopefully people don't take that. I try to be amusing sometimes, or entertaining.
Right.
But the subject to strategy, it really is badass.
Yeah, it is super cool.
And I've done it several times. and it is a great way to acquire properties. The reason I shit on the idea of it is because, like we've talked in the past, there are a lot of people that get into these communities and they feel like that's the only way to invest in
Right.
real estate.
And that makes sense. And it's not the only way, but it is a way. But, you
It's
know,
a way.
and I think that, you know, if you're going to explore this option, like, you have to be willing to put some time into it, because it can't just be like, well, maybe I'll try to call one person and see if they want to sub to me a deal. Like, you really got to, like, build a business off of your one thing for sure.
Yeah. And the way I try to vision in my mind an analogy, it's like being a contractor and always showing up to the job site with wire snippers. You know?
Yeah.
And you feel like you can take on anything with just wire snippers.
Yeah.
Well, really, it's just like when you're dealing with Romex wires is when you should really just be using those.
Right.
You shouldn't be using it to cut your drywall and all those things.
Right.
And that's what I feel like some of these sub 2 people, like, it's only, hey, if it's not sub 2, fuck you.
Yeah.
But there are other tools in the toolbox to
Right.
be able to do real estate.
It's like the old analogy, like, if you have a hammer, everything you hit is going to look like a nail, basically.
Yeah. And that's like the wholesale analogy. Hey, if it's got to be a great deal or F you.
Right.
You know, 99% of the people we talk to, we need your house at 65% of the value, or we're hanging up.
Right. And
know.
and that's what's cool about this stuff. Like, the more strategies you know, like Nick's talking about, the more tools you have in your tool belt. Like, say option A doesn't work, that allows you to kind of branch off and be like, okay, what about 1A, 1B, 1C, right?
Yeah.
So say somebody didn't want to sell or finance their house, right? Like, we could do other things with that. Okay, what if we joint ventured and we bought it together with someone else? Yeah, you could do that. Like, just, I think it comes down to, especially with seller financing and sub 2, solving problems.
Yeah. So here's what I've learned for myself, the most effective way to introduce subject to sellers is when they're in a situation where they need to dump the property quickly. What's worked for me in the past, my first two sub 2 deals were people that were getting foreclosed on.
Yeah.
People that were in pre-foreclosure, meaning that they haven't been making their payments. Their credit's already going to shit. So credit is not a concern of theirs at the moment. Their concern is, do I have somewhere to live next week?
Right.
Their concern isn't even actually like, most of the time it's like, I don't want a foreclosure on my record. It's just like, dude, I can really use some cash to move.
Yeah.
Because I haven't been making the payments. The sheriff's going to be kicking down the door here in a couple of weeks, and I haven't done anything with all these letters people sent me.
Which I'm sure they're getting them.
Yes, they're usually heavily marketed to people.
But you got to be careful about when you market to, pre-foreclosures. You can't, we're not licensed or anything, so we can't specifically target pre-foreclosures.
Yeah.
Is that right? So, like, I can't send you a letter in the mail, or I can't call you, be like, oh, I saw you're on pre-foreclosure. You want to sell me your house?
Now, why not?
That's a good question, because it's illegal. I don't know why, but I think am I right?
You can't market to people in pre-foreclosure?
You can market to pre-foreclosure, but you can't be like, I found you on a pre-foreclosure website. You can market to anyone, but it has to be like, hey, we hit the whole neighborhood. We want to buy your house. But you can't mention anything about...
Where'd you hear that?
MySpace.
Okay, you keep talking.
It was on.
I gotta fact check this. Sorry.
Yeah, please fact check. I heard it on Yahoo.com back in 1997, so I could be wrong. But I thought there was legal implications if you specifically target pre-foreclosure people. Like you can't talk to them like, I saw you on a list for pre-foreclosure. I'd like to buy your house. You can mention, like, if you are going through a pre-foreclosure, I can help you. Is that right, Nick?
Okay, so it's giving me federal laws, state laws, do not call registries, anti-predatory lending laws.
Okay.
Ethical considerations, best practices. So it's giving me a long-winded answer here.
Sure.
Give me just a minute to
Yeah, and that's
digest
fine.
this.
Like I said, like I could be wrong on this, but I thought like the verbiage had to be specific on like, if you're in pre-foreclosure, we can help. Not, I see you're in pre-foreclosure, let me buy your house. And you can mention it, but you can't be like, that's how we found you. And again, Nick's going to do the research on this right now. We didn't come prepared for this because I'm throwing questions out of left field. Apologies. regardless, so like what Nick said, like a lot of people, what they typically want in these situations, they just want, cash to move, or they want cash so their car doesn't get repoed, or they want cash to pay off their other outstanding debts because they're over their heads in some areas.
Okay. So it did give me a long-winded answer because there are multiple different the federal laws usually are, it's the debt collectors calling people and harassing them. There are certain laws to be aware of there, but that doesn't apply to real estate professionals. There are state laws. Many states have their own laws regarding solicitation of homeowners in foreclosure. These laws can be more restrictive than federal regulations. Some states require specific disclosures when marketing to homeowners in foreclosure. So some states require that you have additional disclosures, not necessarily that you can't.
Sure.
In general, overall, yes, you can legally market to people in pre-foreclosure. It just must be done in a compliance with whatever those specific laws are that you're working in, and make sure you're within the ethical guidelines.
Right. And that's, I guess, kind of what I wanted to touch on. Like, if you are going to be doing this, make sure you look at what your state laws are. You just don't want lawsuits over your head for bogus stuff that you accidentally said one wrong thing, because this is all a weird industry sometimes. So.
Yeah, you got to be careful. You got to know what you're doing.
Yeah, for sure.
And less is more sometimes when you're talking to these people. If you come at it from, hey, I heard you're getting foreclosed on. Maybe I can help. Let's sit down.
Yeah.
And start there. Figure out what their situation is, if you can help. Here's what's worked for me in the past. I was given a lead by my partner, Joe Turner, her first year on my team. And she was calling a pre-foreclosure list. Okay. And these people were getting foreclosed on in a month or so. And I think it was actually a couple of months. And they said, oh, I think we got things figured out. Thanks for checking in.
Yeah.
And then they got back to her like 2 weeks before, or 3 weeks or so before they got foreclosed on. And they said, well, okay, so that fell through. Okay. What do you got? Like, can you help us?
Yeah.
And they were out of state.
Okay.
They owned a rental in Post Falls that they haven't made payments on for, I don't know, a couple of years.
Sure.
And Joe asked if I can try to help and call them, figure it out. And I dropped the ball.
Okay.
I let a week go by. I forgot to do it. I forgot to call them. She reminded me the next week. She's like, hey, these people are getting foreclosed on in a week. And can you call them and help figure something out?
Got it.
And I'm like, my bad. So I got on. I called the guy, and he explained the situation. Haven't been making payments, and I don't clearly remember the exact numbers, but I'm going to get pretty close here.
Okay.
I remember he was somewhere around $15,000 behind on his mortgage. He needed around $10,000 to reinstate his loan.
Okay.
So he didn't have to catch up all the payments, but he needed a certain amount of money. Their lender needed a certain amount of money to stop the foreclosure.
Got it.
And reinstate the loan. Because as of that time, it had a sale date of the next week, and it was getting foreclosed on.
Sure.
It was in pre-foreclosure, which means pre-foreclosure, not foreclosed on yet.
Yes.
There's still a chance for the owner to do his thing.
Yes.
So what I learned was that he only owed like $110,000 or so on this property, and it was worth close to 190, 200.
Okay.
After repair value, I wasn't sure what the condition was. I know that it was a rental. It was in Post Falls. It wasn't super old. It was maybe 20 years old.
Was it vacant?
It was. I didn't know that. He thought it was rented. It turned out that the tenants knew that it was getting foreclosed on.
Okay.
They wanted their deposit back from the management company. It was being managed by a third party.
Okay.
So they cleaned up the house and moved out.
No.
So it was a vacant, clean house.
Nice.
Built in the early 2000s or something like that. Or it was late 90s. It doesn't matter. The house was less than 20 years old.
Got it.
It was in good shape. And so he owed a little over 100,000, and they needed about 10,000 to reinstate the loan or something like that. Maybe it was might have been 15, and they were behind on 20 grand on payments, something like that.
Yeah.
What I do remember though was that we worked out a deal to where instead of we can take the property over sub 2. So we would reinstate the loans. We sent their bank money. We sent them, and before we did that, we got the property quit claimed into our name.
Okay.
And while we were doing that, we paid a title company a couple $100 to do a full title search to make sure that it wasn't going to come with any other liens.
Sure. Okay.
So that it was just this one lien, and we weren't going to inherit like a child support lien or something like that, or
Sure.
a contractor lien, something else, or a second lien that they didn't tell us. They got another bank loan.
Right.
So we found out it was just one lien. While we were doing this, we put a rush on it, and I didn't really know what I was doing, but I kind of stumbled through it and just did some quick research, and luckily we did it correctly.
Awesome.
We sent them a quick claim deed that our title company prepared for free.
Awesome.
And we overnighted it to them to where they signed the ownership over to us.
Okay.
Once we got that back in the mail, then they gave us access to their over the phone, the lender, to be able to talk and verify with their lender how much they owed and what it would need to be reinstated.
Okay.
So that we can verify all that too and be on the call with them and be absolutely certain that it wasn't going to get foreclosed on if they received this wire by this time.
Right.
And we were cutting it really close. Like we had a day.
Gotcha.
Because it took some time to mail things
Sure.
and get this figured out. But we were able to stop it like the day before foreclosure. We got the loan reinstated.
That's awesome.
We didn't catch up all the payments.
You just 10 grand out of the 15, you said, right?
Yep. And we gave the seller $10,000.
Okay.
Now I only had 8,000 at the time, but Joe had the rest.
Okay.
But we worked out a 50-50 deal. Said, hey, we're going to work on this together. I don't quite have as much. I don't have half of what it's going to cost to do this.
Yeah.
But she had a little extra money that she had, like an inheritance or something like that she was able to come up with. I think we needed $22,000 total or something
Sure.
like that. So I was shy by my half by like $4,000 or something.
Yeah.
But we had enough to pay this guy 10 grand at closing, get the loan reinstated for another 10. We were like 20 grand all in. And then when we got the property, we had to make like $800 a month payments. But I don't even think we even made one payment because we got that. It was a very unique scenario where the house was in good shape.
Okay.
And we got it on the market like a week after we closed on it.
That's awesome.
And we had a buyer offer done, and I think we had it closed in like 40 days. So we had like 10 days maybe where we should have made a payment, but it didn't really matter because they already had a payoff.
Right.
And we made like $60-something thousand on that.
It's awesome.
In profit.
Very cool.
But it was a way to acquire it with very little money, and it solved his problem.
Yeah.
And he was very happy, and he actually called us a couple of weeks later with another property in Florida
That's awesome.
to do the same thing with.
Did you guys end up doing that one?
We didn't.
No.
We were unfamiliar with the market.
Listen to that, people.
And even though it sounded great, I just, you may look at me as a big risk taker, but if I'm unfamiliar with the market, I don't do it.
I look at you as a calculated risk taker, to be honest with you. Like, I don't look at you as a big risk taker. Like, most things you've done should work out. Sometimes they do, sometimes they don't. But it's specifically important what you said there. Like, you didn't know the market and you didn't want to take that risk. That's okay.
Yeah.
That is 100% okay.
But I didn't leave him hanging. I referred him to an agent that was savvy enough to help him out.
Nice. There you go. Got him a little bit of help in the process.
I think they were able to just sell it on the MLS before it got foreclosed on.
Badass. Very cool.
Yeah.
Couple questions to unpack with that. So obviously, when this was all happening in the pre-foreclosure process, you contacted their bank, and they obviously knew you were taking ownership.
It was a three-way call.
Three-way call. Okay.
Yep. So they were given they granted access to us, the third party.
Sure. So they just
to be
said,
able
yes, we're able to talk to these people,
Yep.
type of thing.
Uh-huh.
And typically, like you said, like you talked to the bank, so you got all the information they needed.
Went to the title company.
You went to the title company. That's perfect.
Make sure that there weren't any other liens that we were inheriting.
Yep. I think people are scared of that due on sale clause on this, but specifically, like, you called the bank and they didn't call the note due because you got them current. Is that correct?
Yeah. Oh, they didn't ask like, oh, are you buying the property or anything
Okay.
like that. They didn't care. It was all about getting that loan reinstated.
Gotcha.
That's all they cared about.
Sure.
we,
So you
we
let them
weren't
know we're
asking,
buying
we
the
weren't
property.
asking for permission from the bank to purchase it
Sure.
and do a deed and a deed transfer. That's something you got to take away from this, is that we weren't asking permission from
Yes.
the bank.
Yes.
And all we were doing was verifying
Yeah.
information.
And like you said earlier too, Nick, like less is more in some of this stuff.
Yeah.
Right? You don't need to tell the bank like, oh, we're planning on quit claiming it to our own name. Like they don't need to know.
No, you don't need to raise red flags. You just need to be aware of the data.
Yeah. What's it going to
Beware
take
of
to
the
get this thing current so you guys don't foreclose on it? Got it. Thanks. Yep.
And even if they called the note due, we had a plan to sell this thing immediately.
Right.
Like it wasn't, if they called the note due again,
Mm-hmm.
then it was going to be another 4 or 5 months before they could foreclose on. We
Right.
would have had the problem solved by then. And we were buying it at such a steep discount, we could have got it refied if we couldn't sell it,
Sure.
because we're at a very low LTV.
Yeah. And if you're listening, please pay attention to that again. Like there's other options. If Nick had to go, if that had to get the note called due or anything like that, Nick had other options in his tool belt to get this deal done.
The loan to value was like 55%.
That's awesome.
So if we had to, we could have taken it to even a hard money lender.
Oh yeah.
And be like, hey, can you give us a loan for this? Because we only owe 105 or 10,000, whatever it was, on the property, and they're calling the note due. Didn't happen.
Sure.
But you usually have several months, and that's part of why I cringed a lot when I went to Arizona and hung out at a Pace Morby event, and all these people were buying sub 2 deals with negative equity and negative cash flow,
Yeah.
just because the mortgage was low, or the mortgage rates were low.
Right. And
But if they're called due, you can't easily refinance a property
no,
that has no equity.
you're in over your head. And that's why, like, Nick, you specifically bought like a good property that would make sense. And if something happened, a fire needed to happen, you had multiple ways to put that fire out.
Oh, totally.
Right.
Yeah.
And that's something like, yes, sub 2 is very, it's good for that. But people need to realize, like, don't over leverage yourself with this stuff. Especially if you're just getting started and you're going after these zero equity properties. The note comes due, like you're shooting yourself not just in the foot, but like
You're also shooting your seller
Yes.
in the face because you told them you were going to solve that problem
right.
for them. They walked away. They went on with life, and then it's like, oh, hey, something came up which could have come up.
Yeah, which very
And,
well could have.
Since we didn't get the property at a good deal, it's your problem now.
Yeah.
Or,
Right. And since you're the owner of the title and everything, like this is going back to you.
Yeah. Well, no, they wouldn't be
Okay.
owner. They were just responsible. They were responsible on the note.
Sure. Okay.
In a sub 2.
Yeah.
So the seller still remains a responsible party for the mortgage.
That's right. Yeah. But yeah, if you're going to do deals like this, just make sure you're doing ethical deals and make sure you're running numbers not just for one scenario, but for multiple scenarios.
Yeah.
And
be very
having-
upfront
yeah.
about what you're doing.
Having a good, solid exit strategy. Like sub 2 is a great way to acquire properties, 100%.
Yeah.
But it's also a great way to lose properties if you're not careful. So
Yeah. And something to point out here, I told them what I was doing.
Mm-hmm.
Some people do sub 2s and they don't explain what it is or what they're doing.
Mm-hmm.
And people don't realize, oh, wait, I'm still going to be on the mortgage?
yeah.
That's a conversation you need to have and make sure that
Yeah.
a seller's okay with that. Because I've seen that before. People put sub 2 deals together and they didn't tell their seller what they're doing.
Right.
Or it didn't really sink in. Maybe they didn't simplify it enough to tell them, hey, you're still going to be a responsible main party on this mortgage. And you need to be comfortable with that.
Yeah.
In order for this to happen.
We'll make the payments on your behalf. Are you okay with it type of thing?
Yeah.
Yeah, just be honest with people. And it all comes down to ethics. And I think that's the problem Nick has with the sub 2 community, I suppose.
I don't have a problem with the community. I just have, we'll talk about it later.
Yeah.
It's just,
I get it though. Like,
just the ad, it was, we'll talk about it. We talked about it on previous episodes.
yeah, it boils down to education in the field.
Education
and
is
education and ethics. To be honest with you, like do good business, and be smart about it. That's pretty much how all these should be done.
I think education was the biggest thing I was a little frustrated with.
Sure.
I don't feel like a lot of these sub 2 people have bad ethics by any means.
Sure.
I just feel like they can use more education on
Yeah.
the reality of real estate and other options.
Yeah.
and backup options, and they should not be buying deals with no equity and no cash flow.
Right. I agree with you 100%. And just the last point I'll make is like, I think like the lack of education can lead to a lack in ethics as well. Because if you're not educated on how this is supposed to go,
Yeah, ethics could be a skill.
you're doing like shady business. Like, oh, I think I'm doing it right. And maybe not. Maybe you are.
Yeah, and that's true. Like just a skill.
Right. Because if you're ignorant in the field, like you have no idea if it's ethical or not to be doing this.
Right. Yeah. And that's something I don't think a lot of people talk about. Like it's just a skill you learn. Ethics can be a skill you learn.
Yeah, 100%.
Because you could just not know and then come off very unethical, but you don't mean to be.
Right.
You just don't know enough.
Yeah. You maybe watched, a 5-minute YouTube video on a thing and you're going to try to implement it in a real world process. And
You don't know the consequences of your actions.
Right.
Yeah.
Legal advice, everyone. We love it.
That wasn't legal advice.
Yeah. What do we got? What do we got next, though?
That was the big thing. There's property exchange. This is okay. So I lied initially in the first podcast. I said we've done all these strategies except for maybe one. This is another one we haven't done.
We have not.
I haven't done a property exchange, but it is a thing, and I've seen it happen here maybe twice in the last 10 years. Me personally,
I hear property exchange, and I could be wrong, but like some of this is like a 1031. It could be rolled into that. That would be a property exchange, right? That's a 1031 exchange.
Actually, no. So what this is, let's say you own a property. You'd like to acquire another property that maybe another investor has, and you guys work out a deal where you just swap properties.
Oh,
you swap title, and maybe there's some monetary compensation too. Like, hey, I'll give you this piece of land plus 20 grand, or a case of beer,
sure,
for that little house there.
Okay.
But this is something that I've seen investors do this before at a very high level. I haven't been part of it myself. I haven't been in that situation, but I might someday.
Sure.
So it's good to know that you just have the option out there to do property exchanges, which is different from a 1031 exchange. That's a tax strategy.
Okay.
Tax saving strategy.
Yeah.
This would be just simply you're trading properties just like you would trade a collectible or basebal cards with your friends.
Yeah. And it's not very common. I mean, you might see it. I've never actually seen it, but like, and again, in my head, I hear property exchange. I think 1031 exchange, which is a tax benefit thing, but it's also a way to acquire a different property. You're not exchanging a property, but you are selling one property in exchange for other properties.
Yeah.
But you're not doing it like, I give you this, you give me this. It doesn't have to be owner to owner type of thing.
Yeah. And specifically, I do remember about a year ago, I was with a very high-end real estate agent investor. I'm not going to mention his name, but he invests a lot in the East Sherman area, downtown. But I remember him telling me that he walked me through this house that he had and that he built, and it was maybe 70% complete. It wasn't done, but he told me he's actually trading this property for some land up north in like Athol or something like that.
Wow.
But another investor and him are just swapping properties. This was an incomplete project. It was apparently going fine, but somebody else wanted it. Another investor friend.
Cool.
And I don't know if there's any ethics or like monetary exchange or anything like that, but he told me he was just trading properties.
Wow.
But he walked me through it to give me some tips on what to do for this other house.
There's
But it was kind of cool to hear that I've heard it before, but it was kind of cool that at a high level people do this, and it's no big thing.
Just a cool strategy. Like, hey man, I've got this card. You've got this house. House. You want to trade? You want to do a trade?
Sure. Yeah, I'll take a project downtown.
Yeah.
Sure.
I'll take my land out in
Take my
Apple.
land.
Sounds like a bad deal, but okay. Could be wrong how much land it is for sure though.
Yeah, who knows how much land it was? Could have been a lot. Could have been development opportunity. Could have been RV park. He didn't really get into details, but
yeah. But you just have to know that it is a strategy. You don't have to utilize it, but if you do have land, or you do have a property, and maybe someone is selling an apartment complex, or maybe someone's selling something that you want, offer to trade. See what happens.
Yeah. Here's the last one we're going to talk about, and this is something I think we both know a lot about, and it has been an excellent strategy for me to acquire properties over time with very little to no money, and that is hard money loans.
Hard money loans. Gotta love them, ladies and gentlemen.
We're already an hour in, but thank you for waiting this long if you're still here.
We appreciate you. We really do.
Yeah.
Hard money loans are a great way to get started. Obviously, like the benefits for hard money, like I always tell people like it shouldn't be your last option, but it should definitely be an option for you.
It should be your first or second
It
option.
should be your first or second option, right? It should be like you should be calling a hard money lender
It should be for me.
for you.
It works for me.
Right.
Sorry, go ahead.
No, yeah, but like it's a good way. So, and I think of this for people like hard money loans for like, okay, I can't get approved for whatever bank conventional financing.
Yeah.
And you can utilize, again, what we talked about. You can utilize some of these strategies together, and we'll kind of go into that too. But hard money loans are great for if you don't have access to conventional financing, or you're just doing a short-term project and you need to secure a property quickly. Great thing I love about hard money loans. Obviously, we do hard money brokering around here, but like we fund within 10 days most of the time.
Yes.
And if you need money fast, and you need good, solid sources of money, go talk to a hard money lender.
Yes. Yeah. So here's what hard money is not, which people get confused. Hard money is not a way for you to get a down payment.
Yes.
It is typically not a way to have somebody fund your whole thing without skin in the game, getting a kind of a so-so deal. And it is typically not a great practice to acquire rental properties with, unless you're getting something that just has an extreme amount of cash flow coming in, and it just makes sense.
Right.
These are typically short loans, about a year or less, 6 months to a year, sometimes 2.
Our average loan is about 7.8 is what we've heard.
7.8 months?
Yeah.
Okay.
So, I mean, we usually make like a 12-month note on this stuff. So most of the time, people pay off that note within 12 months, like much earlier.
This is ideal for fix and flips or burrs for the initial acquisition.
Yep.
Or if you just need to close on something quickly. Here's the great thing about hard money loans. There's a lot of great things about it.
Yeah.
But typically a hard money lender is not going to give you a loan if it's not a great deal.
That's true.
And if a hard money lender gave you a loan on a property, you didn't have to put much down, you probably got a good deal.
Right.
Because they're doing some research on this property.
Right. We underwrite
they're helping
everything.
with the underwriting.
Yeah. And that's a key thing you said there that makes sense too, Nick. Like if hard money lenders are telling you, no, we don't want to fund this deal, it's mostly probably because your loan to value isn't where it needs to be.
It's because your deal sucks and you should walk away and pick a different one.
Your deal sucks. And there's a lot of different ways to fix this, right? So typically hard money lenders, we're looking roughly 65% loan to value is what we really like funding on. So what that means is you're going to have to find a good deal. Typically, there is a down payment of sorts depending on what purchase price you get that property at. And this is all something when you call me or your hard money lender, we go through all those specifics on what we're looking for, how we can make this property happen. But you will need a down payment, which comes into partnerships, right? So if you don't have that money, go find a money source, because hard money lenders, we're not approving you like a bank do. We're approving you on what the property can do.
Yes. They are making decisions based off pure logic.
Yes.
Pure logic and experience versus criteria.
Right.
And, a board of directors and, what the government wants. They're not making decisions based off that at all.
Right.
It's just purely based off their experience on is this going to go well or not. And the reason why a lot of them do want down payments is simply just so that you have some sort of skin in the game. They don't want you to take on a project,
Right.
especially if you're not experienced.
Yes. Especially.
They don't want you to take on a fix and flip, because fix and flips are hard.
Yeah.
They are very hard. But if you're very experienced, if you've done it a few times, you want to get a hard money loan, sometimes they're not going to need as much skin in the game from you if the loan to value is very secure. If they had to take that property back, if you weren't making payments, you just completely failed, are they going to have a good day?
Right.
If taking it back, or are they going to take a bath?
Yeah, and it's all about security with hard money loans. So obviously, with a hard money loan, it's hard because hard is the asset that we're securing, right? The asset is the house or the land or both itself. And in order to get that secure, that's why I said that loan to value comes into place. So what you need is a good deal to start.
Yes.
A lot of times I have people trying to have me analyze deals, and that's fine. I'll analyze the deals, but they ask me like, how much down payment do I need, and how much renovation am I going to need? Or how much renovation are you going to give me? And I'm like, I have so many more questions before we get to that point.
Yeah.
First off, what's your purchase price? What's your after repair value? How much rehab? We need an actual rehab budget. We can't just unfortunately be like, yeah, we'll give you 200 grand.
Yes.
Like, we're going to look at that difference. So your purchase price and after repair value. If your after repair value is say 300 for easy math, and you're buying it for 200,000. That's roughly a 66% loan to value loan.
Yes.
So we're not going to be giving you much more rehab budget than that, unless you come with a higher down payment. And again, that's where we can kind of slide some levels a little bit and try to make this thing work for you. That's an okay deal, especially if it doesn't need any reno. But if it needs reno, that's where it starts getting, and you're tipping the scales a little bit.
Yeah. So if you want to make a checklist, here's a great thing to really have prepared before you talk to a hard money lender, in order for them to really kind of take you seriously.
Yeah.
You've got to have a really good deal under contract. You can talk to them prior to something going under contract, but if you have a great deal under contract already, and or have a really good idea what kind of improvements you're making to the property and about how much it's going to cost, and you have a really good idea of what it should sell for based off comps that you got from a professional. You don't have to always pay an appraiser, but you can go to a lot of brokers or real estate agents and ask for a CMA for the after repair value.
Yeah.
If you had that along with a renovation budget that you put together and a plan for how much margin is in this, and then you ask,
Right.
hey, so here's what I got. Can you tell me what would you be willing to make a loan for? And what would you expect out of me?
Right.
That's a good way to start.
I 100% agree with you. Like the first question I always get is like, how much will you lend on? And I'm like, the amount isn't really what we're looking for. What we're looking for is, do you have something under contract? Because until you do, all of these numbers are a myth.
Fictional.
Yeah, it's completely fictional. They're a guideline. I can give you rough guidelines of what we're expecting. Okay, if you're buying a house and it's at a good LTV, I would still have 15 to 20% of a down payment of that purchase price, just for a hard money lender. But it depends on the deal itself too. Like, I've seen them go for less. I've seen them go for more. Like vacant land deals, we typically need to have a little bit more security than like a fix and flip in downtown Coeur d'Alene, if that makes sense.
Yeah, because the land doesn't have as much utility value as a property. So if you had to take land back, it could be a while before you sell it, and you might have to sell for half of what you thought it was worth.
Right, and that
it doesn't typically happen with homes.
It doesn't. That's right. And typically, like we look at a lot of data. We look at what houses have been selling for and what they could sell for in the next 12 months, because typically, like we said, these ends up being 12-month loans.
Yes. Here's a secret. Hard money lenders really want to lend you money.
Yeah.
They want to do the deal. So keep that in mind. They want to make it work, but you just have to bring them something that is going to be successful for everybody.
Yeah.
And you're going to be able to make a decent profit.
Yeah.
Because if you can't make a decent profit,
they're not going to either.
the lender's not going to either.
Right.
But this could be a great alternative to getting a partner for, hey, you bring most of the money, Mr. Partner, and I'll give you half my deal, I guess. I mean, a lot of newer fix and flippers do that. Like, hey, I've got my mom, I'm going to give her half the money. She's going to lend this. A hard money lender does not cost half.
No.
I mean, we're talking 8 to 10% annual, maybe some points.
Yeah.
But if you... it is more expensive than conventional financing because there's a lot more risk involved with lending to somebody that doesn't have the credit and a house that's in distress.
Right.
And it's a project and it's short term.
Sure. And I will say two other things when talking to hard money lenders. What we typically look for, like what I look for, is somebody who wants to build a relationship with me. I want somebody who's going to, see the value that we bring so we can do more deals together in the future. What I typically see, though, is I see people who are like, what's the least amount of money that I can bring to this deal? And me as a hard money broker, like, okay, like you're trying to scrape by with as little as possible. My lenders are maybe going to want to lend. They may not, though. What I tell people, I'm like, what is the maximum? Like, okay, I know your minimum. I'm going to try to get you the best deal possible, of course. But in order for me to sweeten the pot as a broker, sometimes I'm like, they've got an extra 10 grand they can throw into this deal. And I try to just sweeten the pot for my lenders. So that way, they know they're not over leveraging you. Because if you're over leveraged and you're coming down with very little down, they're going to ask, okay, how is he planning on making these hard money loan payments?
Yeah.
What's his plan for renovation if it goes over budget, right? We need to know that you've got a safe, secure circle in order to keep this project afloat so we can keep funding you the deal.
Yeah. Do you have the money sitting in an account or credit on how you're going to do this renovation?
Yep.
What's going to happen if it goes an extra 12 months?
Yep.
There's that they like to play it safe, but it can be an excellent source of funding regular fix and flip deals.
Yeah.
If you're in the fix and flip game, hard money is it's actually a very affordable way to fund your fix and flips, in my experience.
And with working in hard money for the last like 12 to 24 months, the things I've learned are cheap money isn't always good.
Yeah.
And good money isn't always cheap.
Comes with strings.
Yeah.
Or it doesn't come at all.
Or it doesn't come at all, right?
It's a myth. It's an advertisement.
I've underwrote deals for people, and then people have taken it to other hard money lenders, and they're like, "Oh, I've got this thing funded for 4% down." I'm like, "Great, man. Take it.
See
Take
how
it."
that works.
Yeah. And a lot of times they end up calling me back and be like, "Hey, that deal fell through, or the funds weren't available," and I'm like, "Oh no, oh no, baby."
Did it really? I was not expecting that to happen.
My lenders have access to like $400 million. Like, if we say we're going to do it, we fucking do it.
Yeah. And we have other lenders that have access to much less, but they're cheaper. So, I mean, if you need a hard money lender, give Jeremy a call.
Yeah. Especially if you're in the Idaho, Washington area, that's where we're specifically located. But we do look at deals anywhere. Not in California though. We don't do that.
Yep.
We don't do that.
And so we'll wrap this up. If you need help buying or selling a home, I'd love to help you out. Also, I'm just going to throw this out there. My business partner and I, Joe, we are starting a new little venture with our team. We've had a lot of team success over the last 7 years, and it has to do with just the way we structured our team and the way we put on investor events.
Yeah.
And what we're going to create and put out there is we want to build a business being able to license our model and teach people all over the country how to do what we've done if they want to be a real estate investor agent.
That's awesome.
And be mentored and coached by people that are doing the same thing, that have built a team, surrounded by, creating an investor community and being the center of attention.
Yeah.
It's really done wonders for my business. And we just figured for a long time, I'm like, this would be really cool to franchise what we're doing.
Yeah.
And it just took it just seemed like overwhelming. Like, okay, we own all these, have all these 50% partners and all these different market centers, and how much are we going to have to staff and blah, 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 blah. But it took a while until a couple of our main stars on our team were wanting to branch off and do their own thing. And I just had this idea because I was listening to Alex Hormozy a lot. What if we just, they want to be owners. What if we just license them our thing? And we came up with something that just seemed really attractive, and we want to try it out. So if anybody's out there listening who's a real estate agent in another market center, and they want a proven model and to be coached by millionaire real estate investors that have also built teams, I'm just going to put that out there. Feel free to get in contact with me. We're putting something together, and we're pretty excited about it.
Yeah. Just to expand on that just a little bit, like, Nick is one of the most resourceful people I've ever met.
Oh, thanks.
You're welcome. You're welcome. But I think what you're doing is very cool, and I'm excited to see where it goes in the future. And again, if anyone has any questions about like what this looks like, just reach out to Nick. Like, set up a conversation and see what you guys can make happen. So,
Thanks, everyone. We love you.
All right.
Like always.
We do love you. Until next week, take care and keep investing.
Bye.
Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.